Guys, it's Kajol. Welcome to this video, and today we're going to talk about how to invest in the stock market. So we're going to cover topics such as what are stocks, how to pick the right stocks, how to buy stocks, is investing risky, and when you need to sell. All I want to say though, a quick disclaimer, is that I've been investing for nearly 5 years now, so I have a little bit of experience, but I have learned that there is no get rich quick money scheme. There is no magic way. It takes a lot of time and it takes a ton of patience. I am not patient. But don't worry, we are going to talk about personal finance a lot more on this channel. So if you are interested, don't forget to sub to this channel. But now let's get started. So what exactly are stocks? Well, if you decide to buy one stock, which is also known as a share, by the way, they decide to use the same two words to confuse us even more. But when you decide to buy a stock or a share, you are basically owning a piece of a company, and there are a certain amount of shares that a company has. So let's take Facebook. Facebook as of now is $380. It's worth it. So if you decide to buy one share of Facebook, you are owning $380 worth of Facebook. If you decide to buy 10 shares, you're owning $3,800 of Facebook. And you can see that often that the price of the share fluctuates, it's not steady. And that's because the value of the company is changing. What determines the value? Well, a variety of things. One, demand for that stock, how many people actually want it. The perception of the stock. As well as the financials, the revenue, and there's a ton of factors. A lot of it, there's a big psychological part. It's not all down to data, and that's something really key to know about the stock market. The fundamental rule is that you want to buy stocks which you think are going to go up, and you want to sell stocks which you think are going to go down. And if you know there's one fundamental rule and stick to it, you probably will do very well on the stock market, fingers crossed. So how do you really decide what shares to buy? And there are tons of investing strategies that people use to help to decide that. But we're going to go through the three main ones, which is known as value investing, growth investing, and income investing. So value investing is something which I actually made 200% of a stock called Chariot Oil and Gas in a matter of few months. And essentially it's so simple. Basically, you are buying stocks which you think are undervalued to what the price is on the market. And to determine its value, some people use a tool called fundamental analysis, where you're basically going through financial statements like income statements, balance sheets, to understand what is the actual value of that company versus what the market perceives that value to be. You are basically betting at some point that the market will realize what the true worth of that company is. So for instance, if a company is at £4 on the market, but when you do the analysis, you see that it's actually worth £30 in the future, you can decide to put your money in now with the hope that the market will realize it's worth £30 in the future. And often there are tons of data analysis that you can do, tons of metrics you can use to help inform this decision, and this is not really speculation. There's tons of data and statistic modeling that you can do to do this. Now, don't worry if this sounds really overwhelming. You're like, hey Kajol, how do I do statistical modeling? Basically, there are people who already do this for a living, and sometimes I like to follow certain people who do this. One is a guy called Simon Thompson. He writes for the Investors Chronicle, which is also owned by the Financial Times. And basically, he lives and breathes fundamental analysis. He does value investing, and he always finds me the bargain shares. So have a look, and I'll leave a link in the description box if you're interested. The second strategy is called growth investing. And this is really blown up over the 2000s, really. And especially, during the pandemic, there have been stocks which basically have been showing above average growth. For example, Zoom over the pandemic grew incredibly fast in its share price, but often the value of that stock may not match up to it. So sometimes it may be overvalued now for what the share price is showing. That type of strategy is called income investing, and this is basically where companies feel a little bit nice and they decide to give you some free cash on top of all the shares you own for them. So basically, they give you a dividend on top of the shares you own. So you typically get a dividend for every share you own, and a dividend is a share of the profits essentially. And this is up to the choice of the company. Not all companies give dividends, but often really safe companies do. So companies which are so big and have so much profit, they decide that, hey, actually we can decide to share some of the profits this year to give back to the investors. So companies like Next, some big banks as well decide to do this, and don't expect your share price of those companies to change quite a bit, but they are good if you want a reliable amount of money coming in, and often it's better to put your money into dividend stocks like these, because if you put your money into a bank account with like 0.1% interest rate, you can get up to 4 to 7% with the right stocks, just from dividends coming in every year. So it's absolutely great way to get a reliable source of income coming in. If this sounds a little bit overwhelming, don't worry. There are people who do this for a living, and essentially you decide to give your money to a fund manager who invested into stocks on your behalf, and that's essentially called index funds. So you are basically putting your money into an index fund. Often you can see the top 10 shares that they invest in terms of percentage of your money they invest in, and you can also use historic data to understand how well that index fund does on average. So let's take a look, and the one we're going to look at is JP Morgan Emerging Markets. So there's a variety of metrics, but we're just going to look at the performance right now. And you can see over the last 5 years, if you had invested in this fund, you'd be making an 87% return, which is absolutely crazy. And you can also see that top 10 holdings, these are the 10 companies they put the largest amount of your money into. You can also see which sectors they sit in, as well as which countries. And you can see China, India, Taiwan are the highest ones, which is great. The good thing about investing in funds is that you're investing in tons of companies at the same time. So the chance of one of those companies going down isn't going to really affect your investment as much. And you typically are much more safer investing your money into index funds, and it's definitely a much more less risky version than typically just stock picking an individual stock itself. So how do you actually buy a share, and where do you begin with that? And honestly, back in the day, it was just like Wolf of Wall Street, where you typically phoned a guy up and who's called a broker, and you'd be like, hey mate, I want to invest £10 worth into Facebook. Whereas now, today, you can do all of it at a click of a finger online, and there's tons of digital platforms that you can use to do that. What app and what platform to use really does depend on which country you're in, because there's different financial laws. So I'm going to just go through a couple for the UK and the USA just to get started. Of course, do your research, understand the commission fees for this, understand the interest rates, understand, if you find it clunky and the user designed to be clunky, understand the detail that they're giving you in terms of financial information. So for example, in the UK, a few are Interactive Investor, Trade 212, Hargreaves Lansdown. In the USA, obviously there's Robinhood, there's Webull, MI Finance, Wealthfront, there's tons. And do your research, and if you want me to do a video on the different platforms you can do and what's probably the best platform and ranking them against each other, let me know. I can do that too. By the way, if you're in the UK, you can open a share trading account or a stocks and share ISA. Basically, with a stocks and share ISA, you do not get taxed up to £20,000 each year on any money you earn from stocks you invest in it. So please make sure you have the option, or even decide to go and open a stocks and share ISA. That's what I use, and I'm making sure I'm not paying any more tax than I'm already paying for my job. So is investing risky? Well, what I love about investing in stocks is, one, the barrier of entry is incredibly low. You can literally start to invest with $1. And two, your risk appetite, how risky you want to be, is totally up to you. So what I would say is that your risk, the amount of risk you should take, really does depend on your financial positioning, in my opinion. So let's say you have a lot of debts which have racked up, and especially those high interest debts, what that happens is that debt compounds interest just like any gains do. So you want to pay off those high interest debts first, but if you do have debts, you probably want to take a low risk profile, because any additional money you're putting into the stock market, if you lose that, well, it's not going to be good. But if you do have a ton of money kind of kept on the side, you paid all your debts off, you can probably invest your money in a bit more riskier stuff, like oil shares, for instance, or growth stocks as well. So your risk appetite is totally up to you. But there definitely are platforms which kind of ask you what your risk appetite is, and they will invest your stocks based on it. So if you're low risk, they'll put your money into index funds, which are less risky compared to, let's say, more riskier index funds as well. So when do you sell? And in my opinion, stock investing is a long-term game. And I think majority of people have the same mindset. In the long term, the stock market always goes up, and in the short term, it can crash. But we can see that over the last 20, 30 years, the stock market has always been correcting itself, and it's always been increasing. What I think you need to ask yourself is, do you want to be a trader or do you want to be an investor? Now, a trader definitely does it for the short term. They try to time the market, whereas an investor kind of focuses on long-term investing, time in the market. Personally, for me, I like to hold my stuff for the long term because I know through all those booms and those busts, my money will always go up, and it just makes me be able to sleep at night a little bit more, to be honest. In terms of what broker accounts to open, how to find winning stocks, more investing strategies, I am going to cover these in so many future videos. So if you are interested in this content, don't forget to subscribe to this channel. And for now, I will see you next week. Toodles!